Hello and welcome to session 5 of our Series 7 exam overviews by Passing Score. In this video we'll be going over Reg T. Reg T are the borrowing and payment requirements set by the Federal Reserve Board. So all the things having to do with payments, margins, broker-dealer rules for buying and selling are covered under Reg T. Let's get into it a little bit. Let's start with the payment dates. The payment dates aren't necessarily the same as the settlement date. Cash securities are settled and paid the same day, but corporate securities have T+3, but they're given an extra 2 days to make payment for a total of T+5. Options settle quickly, T+1, but they have an extra 4 days to make payment under Reg T. U.S. government securities and munis are exempt from Reg T, and they settle at T+1 or T+3. So if you don't pay on time, what happens is your securities will be sold off so that broker-dealer gets their money back, and you can be frozen from credit for 90 days. You should know about potential exceptions to these rules. There can be requests to the NYSE or FINRA under certain conditions to extend the payment dates. Reg T also defines who is a pattern day trader. That's 4 or more day trades within 5 business days at a minimum. A day trade is a pair of trades like a buy or sell or a sell or buy on the same security on the same day in a margin account. The broker-dealer can have different definitions and rules, and they can actually even designate you a day trader even if they just believe that you will be a pattern day trader in the future. What that means is that you're going to have to hold more equity in the account, at least $25,000 more before any day trades, and you keep it there for at least 2 days after any trading activity. And again, the broker-dealer can have even tougher rules than that. If you want to get off the designation as a day trader, you have to have no day trades within 3 months, and then you can request that the broker-dealer take you off the day trader list. So remember, 4 within 5 means an extra $25,000 in equity. Options under Reg T cannot be used as collateral unless there's at least 9 months left until expiration of the option. Otherwise, most options are less than that and are worth nil as far as collateral is concerned. Even when you can use them as collateral, only 25% of the market value can be used. Index options are considered uncovered, so you always have to deposit margin for those, since it's not practical to own all the shares in an index, and you have to have the initial equity requirements of $2,000 as well. So remember, 25% of the market value for an option if it has at least 9 months left until expiration. Covered calls under Reg T also don't require margins in and of themselves, but the premium can be used to meet any margin requirements. A covered call is just a 2-part position in which you write or sell a call option and you own the underlying asset, the stock or whatever it is. You get to keep the premium, so you make that amount, and your risk is offset by having the underlying security. So remember, a covered call is when you own the stock, but you write a call on it as well. A covered put is very similar. In this scenario, you write a put option, but you also have the offsetting asset or position so that your risks are completely offset, and again, you make the premium. This can be done in a cash or margin account, but if you buy one of the positions using margin, you will have to pay the margin on that as well. The premium can also be used to meet the margin requirements in this position as well. An uncovered option is just the option by itself. As we saw in the other ones, we had the offsetting asset, but in these we just hold the option. And in this case, we need at least $2,000 in equity. The margin requirement is actually the current premium amount plus 20% of the current market value less any amount that you're out the money, or the current premium amount plus 10% of the current market value, whichever of these two is higher. And other options for uncovered spreads, those require margin deposits. Covered calls and covered put spreads have no margin requirements, but straddles and combinations cannot be used as collateral, but they contain short positions within those total positions, so they require margin deposits on the short sides of those. Long margin positions are used to calculate the equity that the client has in their account, and it's determined by the net between the long market value, which is the total market value of the holdings in the account, less anything they've borrowed from the broker-dealer to obtain those securities. So our equity is the net positives and negatives, the total market value less the debt balance. In our example here, we have a client who has 400 shares with a market price of $125 each, but he owes the broker-dealer $20,000. So our long market value is $50,000 less what he owes the broker-dealer of $20,000, means his equity is $30,000. Now he also has to maintain 50% margin requirements as well, or else he'll become a restricted account, which we'll look at in just a minute. Now his excess equity is the total of the equity less that margin requirement. So our $30,000 equity less 50% of the $50,000 market value in the account means he has $5,000 of excess equity in the account. So for now, he's okay. Our initial margin is what we need to first buy the security at the beginning. So this can be either $2,000 or 100% when it's a small amount. But once we get over $4,000, we're going to use a 50% calculation to determine our initial margin. New issues cannot be used as collateral or be bought on margin until after 30 days. Mutual funds can't be bought on margin either, but they can be used for collateral after 30 days as well. Now our maintenance margin is what happens after we buy the security on margin. It's the amount that we have to keep above in order to stay out of trouble in the account. The equity in the account can't fall below the 25% based on this formula here, what we just saw for the long margin calculation. And there's a quick way to calculate that. We get our debt balance, the amount that we owe to the broker-dealer, times 4/3 to find out what our minimum market value is to stay out of trouble. So remember, it's the debt balance times 4/3 and you'll get your minimum market value. SMA is a special memorandum account, which is to say a client line of credit from the broker-dealer. It's generated by either cash dividends or interest payments, sale proceeds, or by excess equity above the 50% margin requirement. Now, excess equity can move up and down, but when it moves up, you get to keep the amount of SMA that's generated by that excess equity. So it's not the same as excess equity, but excess equity generates SMA. Your line of credit or SMA can be used to buy securities or withdraw cash as long as you stay above your maintenance margin, that 50%, and certainly above the 25%. Our buying power is the total amount that we have in the broker-dealer account that's available to buy securities. In a cash account, the buying power is equal to the cash balance because we're not borrowing any money. We're not using margin. But in a margin account, the buying power is the total cash in the account plus any line of credit times 2. So using our purchasing margin of 50%. So in our example here, we have a client with $1,000 of cash in their account, plus they have a $5,000 SMA for a total of $6,000, which means times 2 or divided by 50%, they have a total buying power of $12,000, which they can use to buy securities. Now, when we fall below our 50% Reg T requirement, we become a restricted account. Now, this isn't going all the way down to the maintenance margin of 25% where your securities start to get sold off. It's below the 50%. And we become a restricted account, which means there's a little bit more risk in the account. So there's a few changes that happen. First of all, there's no cash withdrawals from your SMA anymore. and 50% of any sale proceeds are used to reduce your debt or your debit balance. And any buys that you make are subject to the 50% margin requirement, which is actually no change. Now, if there's a buy and a sell on the same day, you can use your margin to make up the difference, just like you would when it wasn't a restricted account. Now, if you in our example here, if you have a buy of $10,000 and a sale of $5,000, you're short $5,000, but you can still use your 50% margin for half of it and deposit the other half that you need, $2,500, into the account for these two transactions. Now, in the reverse scenario, where you're buying $10,000 in this second example, and you sell $20,000, you're netting $10,000, but half of that has to go to the SMA account. So we take the difference times 50% for $5,000 that goes to credit the SMA. In a short margin, this is the reverse of our long margin calculation that we calculated earlier. We're betting in this scenario that the stock price will go down, so as the market value goes down, our equity goes up. So we can see here our credit balance minus the market value nets us our equity. And let's go over an example of that so you can see how that works a little bit. We have a client that sells 10 shares at $230. So they have proceeds of $2,300 at the very beginning because they're shorting the position. They deposit 50% to make their margin at $1,150. And the total, because they have proceeds of $2,300, they deposited cash of $1,150, their total credit balance is $3,450. Now let's say in a few days that the stock price starts to go down, which is a good thing for our client because they're betting on a decrease in a short position. So their new market value is 10 times $223 for $2,230. So our equity is now $3,450, our credit balance, minus the short market value of $2,230 for a total equity of $1,220. So that's taking our $3,450 we first calculated less the new market value to get our equity. Now they have to stay above their Reg T requirement of 50% or else they'll become a restricted account, as we saw. So we take our market value times 50% and we get 1,115. And we take the difference, our equity minus our margin requirement, to get our excess equity of $105, which is positive because it's a short position. Now, if we have a combination of positions on our account, we can have long and short calculations that we have to make. We can combine them into one formula to figure out what the total equity is between all the positions. So we have our long margin calculation of the LMV less the debt balance, the amount that we've borrowed from our broker-dealer, which we calculated before. We saw those two. And then we just saw our credit minus our short market value. And so it's just a combination of our two different types of positions to get the total equity in the account, a combination of all the long and short positions together. So that's it for our Reg T overview. If you have any questions or comments, please feel free to email me at john@passingscorefinance.com, or feel free to get more information at our website, passingscorefinance.com. And good luck on your exam.